Hi, I'm Tony Van Veen, CEO of Discmakers. You know, a couple of weeks ago when Universal Music Group's quarterly financial report came out, their stock took a beating due to them underperforming versus financial analysts' expectations. One of the main reasons mentioned for the poor performance was slowing U.S. streaming subscriber growth. I don't remember the exact numbers, but the case was being made that the US and European streaming markets were getting closer to saturation, that such a large part of the population was already a paying subscriber that inevitably the growth rate had to slow down, which makes sense. It's simple math. And since UMG makes something like 85% of its revenues from streaming, the stock market didn't like that news. The question for you is slowing Spotify and Apple Music subscriber growth bad for you as an independent artist? My opinion is no. Au contraire, mon ami, it could actually be good. And here's why. UMG and the other majors, they deal in mainstream music by big artists. Therefore, they are highly dependent on the size of the streaming subscriber market for their revenues. The more streaming subscribers, the more streams for the majors. You, as an emerging artist, on the other hand, are not dependent on the overall number of streaming subscribers for your revenue. Most of your streams probably come from fans who discovered you in some other way first, at a concert, on social media, or YouTube, and who then came to Spotify or Apple Music or Tidal to stream your music. And most of your streaming growth comes not from the total growth in overall subscribers in a market like the US, but instead comes thanks to your own effort, releasing new recordings, performing, and networking, and fan building. So slowing total subscriber growth won't impact the growth of your streams in any significant way. It probably won't have any negative impact on you, is my guess. But here is the potential silver lining for you. To keep the stock market happy, every streaming platform pretty much is expected to keep driving revenue and profit growth. With large US and European market growth slowing, where do you think a chunk of Spotify's revenue growth is going to come from in the future? From subscription fees going up. Over the past couple of years, Spotify has already gone up in the US from $9.99 to $10.99 and now to $11.99 for an individual subscription. And here's why that is actually good for you as an artist. You see, Spotify pays a fixed amount of its revenues out in royalties each quarter, somewhere close to 70%. It divides those revenues by the number of streams, which sets the per stream royalty rate, which is very roughly 0.3 of a penny per stream in the US. As subscriber growth flattens, the growth in overall streams will flatten. Not good for the majors, but as we already discussed, doesn't really matter to you. But Spotify needs to keep growing revenues, so it will continue to slowly increase the rates it charges its subscribers. So if subscription revenues go up faster than streams in a saturated market, your per stream royalty payout will also increase slowly. Think about that. Flattening streaming growth could actually end up paying you more. Weird, right? To give an extreme example, if streams did not go up next year, but the average subscription price went up 10%, you would be paid 10% more for each stream you got. One side note about whether growing markets like India, where subscription rates and royalties are much lower, will negatively impact your royalties, the answer is no. Spotify calculates its royalty rate per territory. So if you are a US artist with a mostly US fan base, it doesn't matter that a low subscription fee market like India is growing like wildfire. Your US royalty rate is based on US market economics for Spotify. And for clarity, I've been saying Spotify, but I'm really talking about the vast majority of streaming company economics in this case. So what does all this mean? Well, if you didn't realize it yet, your music revenue dynamics are so different from the major labels. They rely on streaming for 85% or so of their revenue. For you, it's what, 25%? Even less? As an independent artist, so much more of your revenue comes from performing and selling merch and physical media. And so much of your growth comes from you growing your fan base, not from overall streaming subscriber growth. Which is why I've been saying that the slowing in US and EU subscriber growth could actually be good for independent artists like you. Because if you combine the streaming growth you drive from growing your fan base with a slightly higher streaming royalty, you may see a nice little bump in streaming revenues, which is always welcome. So just keep doing what you've been doing to grow your fan base. Sell more tickets, more merch, CDs, vinyl. Grow your following on your socials, on Spotify, Apple, and YouTube. Keep building that fan base. If you just keep grinding, the rest will take care of itself. I hope you found this helpful. See you next time.